this video, we're going to be chatting about building a purely passive income portfolio that mainly focuses on cash flow generation from like a relatively risk-adverse standpoint. This is kind of what I've been gearing my portfolio to for the last maybe almost year. I've been bouncing back and forth between like different investing philosophies or ideas, and I think as I'm maturing intellectual, the more I'm learning and maturing in this, I guess, investing space or personal finance space, the more I'm finding out what I want out of it, how to achieve those, I guess, goals, goals. So what I'm going to be talking about today is sort of my current or not even investing thesis, but my investing approach, why I am investing in certain things, and I guess my goal is I want to build, I guess we can write this down, my investing goal, wow, I did not spell goal right. Let me zoom in. My investing goal. Actually, I can't start the video off writing an error, but so my investing goal. My goal. I want a relatively not risky, so I guess risk adverse portfolio, or I have a high certainty that the things that I'm buying will continually generate that cash flow for me. So my goal, it's got to be a cash flow portfolio. Why can't I spell today? Cash flow portfolio, risk adverse, and I mean obviously adverse. Obviously, it's gonna be risk adverse is kind of dependent on the individual, but relatively risk adverse. I say maybe on a scale 1 to 10, 1 being super risky, 10 being like only bonds. Like it's maybe like a 7, 8. So that is and I want it to be relatively not low maintenance, but maybe low maintenance is the correct word to use. I think that's fine. The goal is pretty broad. So right now, how can we get to this? So maybe we'll do that. I want to talk about the different things. So we got cash, the different things to buy. We got cash, obviously stocks, individuals. We got ETFs. We got bonds, different kinds of bonds. It could be corporate T-bills, notes. I guess CDs are different, but bonds will lump in all that stuff. Cash type bonds. There are other investments, obviously. Actually, do we want to add REITs? I guess REITs will go under stocks. If the asset doesn't, so I guess I should clarify div stocks. We need div stocks and div ETFs. Again, it comes back to I want the asset to have some sort of cash flow with it, even if it's 1%. It has to be, or 1% of the 1% yield. Yeah, it must have that at all times. And cash right now does actually. What I read that cash right now it does have a yield. I'm very excited about that as I just started putting more money into that. I'm missing one though. Collectibles, it doesn't really have a yield. I mean, businesses have a business doesn't really count for this because this is mostly investments. And I guess businesses are investments, but I want this to be more passive. Yeah, passive. Okay, we're narrowing it down. Passive cash flow portfolio, risk averse investments only. So cash right now in high yielding accounts, where you can get about like 4 to 4.5%. Just in. Actually, I probably should keep it straight. Sorry, I'm at an angle writing. 4% with just putting money as cash in these accounts. That is absolutely insane. So right now, what I started doing is I don't recommend people do this, obviously, but this is what I've been doing. I want to make that clear. Discover, or Discover. Discover has, I think it's about 4.2% yield for cash. So in their account, you just put money in. It's like a savings account, and they're giving you 4.2%, and they're paying out interest payments every month. So on $10,000, you can make $400 a year, just by keeping the money in there. That's crazy, and you have access to the cash, which is important. Different than a bond. Like bonds right now, that the T will do T-bills. We'll do just do quarterly. The quarterly bills are yielding about. Oh, sorry, I haven't written in a long time. So my handwriting's messy. T-bills, they're yielding about 3%. The government, U.S. government T-bills. So it's like, okay, why would you ever? All like Discover is doing, or like other companies, banks, they're just taking the money you put in and then they're shoving it into these bills or bonds, and they're able to generate that little bit of margin, maybe like 1%, maybe 0.5%. That's how they're making money. They do that at scale. The thing is, though, from a personal perspective, like you as an individual, you don't want to have all your money locked up in these bonds, because what if you need access to the cash? So you accept that you're gonna have a less yield on the cash, but you have access to it in case something happens. So that's why there has to be some separation between those two, and you kind of need them. Not need them both, but for me, I want them both. Dividend stocks, if individual. So these are all individuals. I'm gonna be more selective with my companies. Selective. I want low debt companies. A lot of free cash flow. And the payout's gotta be, reasonable. But yeah, the big one here though is low debt for me, because right now in my portfolio I got things like Walgreens, Verizon, 3M. There's one more, but those three, a lot of debt. Verizon, man, they're yielding like 6, or I think it's like almost 8% now on their dividend, but they have so much debt, and they have to refinance their bonds eventually. If they're forced to refinance the bonds at a higher rate, man, those interest payments are gonna be crazy. I don't know. I don't like that situation. I would rather own a dividend ETF to have access to other stocks. Like, I don't care if the dividend ETF holds, let's say, Verizon, because that's more actively managed. So they're going, and the percentage of that ETF is the percentage of any stock is quite small relative to the ETF. So I like that. Dividend ETF, so I'm looking at things like, again, I don't recommend these, but CH, wow. I think VYM, I think those are the two right now. There's some other ones, but they all have relatively the same assets in them. But these right now, I think, are yielding about 3.1 to, I think it's like 3.5%, which, like 3.5% is actually a pretty good amount. I think this is relatively safe. I think it could come down. But the thing with this is the dividends do fluctuate because of the asset turnover rates of these ETFs, but it's okay. The expense ratio is so small with these; it's like 0.6% or something, which is almost negligible. But okay, where are we? I feel like I've just been rambling. So these are I guess, should we put REITs down? I'm just gonna write dividend stocks over here. We're gonna include REITs. So I'm gonna write down my top stocks. But again, these are for me. Is it Ruger? Yeah, we'll put Ruger down. my buy list. Anyway, these are some stocks I haven't bought in stocks in a while. I think there's no reason for me to buy stocks when you could yield like 5% or even 4% by doing like nothing. So that's just my opinion. Completely risk off. All right, so these are my vehicles in getting to my goal of creating a cash flow portfolio, relatively risk averse, and basically entirely passive. Now we'll get into like a little more specifics. Again, these are things that I'm doing, so just be careful. If, just because I do them doesn't mean they're right. Currently, most of my money, it's basically August. It's like July, yeah, it's August. August 2023. Most of my money is I'll put it in order. I think it's cash, bonds, div stocks, and div ETFs. So in this order. Now the cash and the bonds, they fluctuate a lot because, I'm not saying it's the same thing, but it's relatively the same thing. Just it depends on the ability to, use the money. Like cash is obviously more liquid, but the reason why I like cash so much is because, again, you could get like 4.5 by doing nothing. By doing nothing. Then you do nothing and you have access to it. Access to the cash if you need it. The bonds are good because let's say you get 5%. Let me zoom in a little bit. I'm sorry, my handwriting is atrocious. You have 5%. It's a little more yield. But you sacrifice the access to it, access to cash. The div stocks are good because so the only stock that I bought recently is Simon Property. I just think they're great, and I got them at $116, so it was like a 6.3% yield. Sorry, 6.30% yield, 3.7. That to me seemed like a pretty good deal, but it's not based on the yield, it's based on the company, and I just was attracted to also the yield. Dividend stocks, they offer lower yield. Let's say, if it's below like 2-3%, if a dividend stock is paying below 3%, I would rather just buy the ETF or wait until there's better opportunities. Because like right now, why would I buy a dividend stock when I can just buy the bond and get like more yield with less risk? And I get there's no appreciation with the bonds, but there's also no risk to depreciation with the bonds, if that makes sense. Dividend stock, let's say they're yielding 3 to 4%. So it has appreciation potential, but can decrease in price. Like again, buying a stock and holding it forever is, I don't think that's ever a good idea, and it's interesting people on YouTube say that because it just gets clicks, or it's like more like clickbaity. Who cares if you buy the best stock and you're like, oh, I'm gonna hold on to it forever. Like it doesn't mean it's gonna go up. It doesn't always mean they're gonna be paying their dividends consistently. I think 3M is the perfect example. They're just in some hot water, even like Verizon. But again, it's just dividend ETFs are about 3 to 3.5%. I like the dividend ETFs too now. I've changed my point of view from like a year, 2 years ago, because now I understand, how they work. Like the asset turnover rate, how the dividend percentage actually works. I like these because we get access to the div stocks with less risk. mean by that is, like, I like buying, individual stocks, but this isn't my job. I mess up. I pick bad stocks. So, and I don't know what stock is going to be good in 5 years. But what I do know is that whoever's managing these dividend ETFs, they will fluctuate the stocks. They will, buy and sell here and there. The asset turnover rate for SCHD, I think, was 14%. VYM was 9%, maybe 8. I looked this up yesterday. That's how I remember. To me, that's great because, again, they're managing it slightly and moving the stocks around. But I don't need to necessarily be on board with that as long as their investment goals are aligned with mine. I think we're solid. So all of these cash bonds, dividend ETFs help out or will get me to my cash flow portfolio goal. My investment portfolio goal. Because I don't have to do a lot. I mean, I still have to go and I gotta move the money around for the bonds and actually buy the stocks and ETFs. I have nothing automated. Like, there's not like, oh, this amount of money goes into like CH or any ETF or any stock at any time. I like to manually do it because I want to buy when I want to buy. Not like I know people are like, oh, the market goes like this and it'll go like this over time. Sure, if you think that. I want to be like, hey, at certain moments in time, there's going to be better opportunities. Like right now, bonds and cash, it's insane. I mean, this is not the most bonds have ever yielded or cash has ever yielded, but relatively to like the last 20 years, this is crazy. I think the stock market is still very expensive because there are better alternatives out there. I don't think the market is still taking into it. I guess the market is predicting that the cash and the bonds, the yield on those are not going to be sustainable, I guess. I think the market expects it to go back down because the market is still so high in price compared to like the what I'm trying to say is kind of difficult, I guess, but cash and bonds offer such a great return right now with such little risk compared to stocks. And the stock market as a whole usually or should be discounted because there are other better investment opportunities out there. But not enough money has flown out of the stock market and into these other assets or these other investment categories to actually show a discount in the stock market. I don't know if we'll get that. I'm not sure I really care. I care actually because I want to buy good stocks at cheaper prices. But I don't care right now because I can just buy other assets. So I guess percentage-wise, let's go over here. Percent allocation. This is gonna be quickly like a really brief estimate. Stocks. I'm only gonna include the stocks that I have dividend specific purposes. Cash. Actually, let me do some quick math in my head. Cash. I don't want to write numbers down, but I want to give you guys something somewhat accurate. Okay, let's say that I guess that's pretty. Can I round? I'm gonna round it a little bit to make it a little bit better. So cash right now, at this exact moment, again, these are gonna fluctuate very, very on a quarterly basis, pretty intensely. Because when the bonds expire, they'll go to cash for a little bit, and I might decide to keep it in the account 20%, or throw back in the bond because I don't need the money. I don't need access to the capital at that current moment. We'll say this is. Oh, these two combined. I think that's a great way to start. This is about 40%, I would say, and then bonds are about 30%. Stocks are about 20%. Actually, it might be a little more, 40, 30, 70, 80, 90. ETFs are low. I think ETFs might be like 3% right now. I have to increase this. I don't have to increase it, but I will increase it. Yeah, I think I fudged these numbers a little bit. I think it's 40 roughly. And this is whatever that is, like 17, 80, 90, 100. So I'll just rewrite that 17%. This has got to get increased though. I want the ETF should be, so relative to this, the ETF should be well above the stocks, just because, again, it's the risk. So ETFs, I want it to be like 75%. Stocks would be 25%. I'm sorry. I am just terribly sorry how bad my handwriting is. The reason why this is so offset is because I guess within the last like 8 months, not 8 months, like 5 months, I'm like, ETFs, okay, they're not bad, and I haven't had time to buy them, and I just don't see the reason when I could buy other things. The stocks are, that's why the stocks are so inflated. So I guess I wonder how long this is. Yeah, we guess I got some. I mean, we had time to chat, but I just don't want to talk for like 2 hours. The bond, those are dividend stocks. I'm more particular with what I'm going to be buying. And what I mean by that is, like, I have Verizon, I have Walgreens. Let's see, I have Intel too, but Intel's kind of like a maybe potentially bad trade, but we'll see. Like these companies, I do not that I don't want to add. I'm in the whole 33% down on Verizon, 30% down on Walgreens. Verizon's 5% of my portfolio, Walgreens is 6%. And that's after that huge decrease. Yeah. Gotta be more selective. Also, I know like O is a great company, O Realty, the REIT, even things like Procter Gamble and J&J. The problem I have with all of these is I still think they're expensive. Like they're just so expensive, and they're just better assets out there to buy. These are great companies, but again, if everybody buys it and inflates the price up, and the earnings are a little bit farther away from I guess the PE ratio is farther away from what it should be, or I think it should be. I don't want to buy that. I could just buy the dividend ETF, and it kind of offsets that. But if a company isn't yielding a certain amount, and I don't like the company enough, I'm not gonna buy it. Because, like, I know, like, people are like, oh, Microsoft, even Apple. These are not dividend yielding stock. I mean, okay, they yield a dividend, but what is it, like a 1% maybe? And I don't care about the growth of the dividend really either. I guess you have to compare the growth of the dividend with how much they're actually earning from their free cash flow. Because even if I buy Microsoft and they're yielding 1% dividend, and that goes up, and their dividend increases 100%, great, I'm at 2% yield. Wow, incredible. Like, I'll just go buy something else with a higher yield. And again, getting back to this, I'm not hating on these stocks that much, but I'm saying it doesn't align with my goal. I want, if I can buy a stock and my appreciation is expected to fluctuate, like the beta or whatever, maybe it goes up or down 10%. Like any given year, that's maybe 5-10%. That's not bad, because I don't care necessarily that much for the appreciation, and I don't want to have a lot of depreciation. I would rather care about the yield. But I still obviously would like some appreciation because that's why I'm buying the dividend, or sorry, that's why I'm buying the stock. And I would hope that they increase their dividends over time as well, along with their earnings. The problem with Apple and Microsoft is Apple, it's already so expensive. They're not yielding a lot amount. Even if they increase the dividend 100, 200%, it's not, I could just buy something else. And who even knows if they're gonna do that? So for my goals, things like Apple, Microsoft do not align. And it's okay in the dividend ETF though if they have obviously Apple, Microsoft, because again it's part of that ETF's I guess investing goal, and if they think they need to do that, then sure. But that's one thing I want to note about that. So things like Apple, Microsoft, I'm trying to think of some other like big companies. I think like maybe I'm thinking of Granger. Yeah, regardless though, I want the cash flow. If I'm buying the stock, I would like some appreciation, but it's not dire. Does that make sense? I'd rather the appreciation, or no, not the appreciation. I'd rather the money, the return on that investment come from the dividends, and I want to minimize the downside from the stock price probably dropping. And that's one thing that like Verizon and Walgreens, it just like hurt because I thought they were pretty good companies at the time. I mean, they're good companies, but I'm just saying like they dropped so hard in price. Like I could pick it up right now so much cheaper, but just because the dividend yield got higher does not mean it's a better investment. The companies are still in a little bit hot water. It's okay. So getting back to this real quick. It's a better investment than when I bought it because the potential upside is now higher because the stock got cheaper. But it's just, I don't know. I forgot what I was just talking about. Verizon and Walgreens, I thought they were pretty good investments. The dividend's high, and the dividend's even higher now that the stock dropped, but I would rather put my money to something else because to me, the debt with these companies makes them risky. Riskier, especially in this current interest rate environment. That's concerning to me. But I can own a little bit here and there in the portfolio, that's okay. I'm not going to add though, even though the yield is very attractive. That's the thing too, offsetting that's like the tricky part too, is like Exxon's my best stock right now. I bought it when the yield was like 9%. Great. But it's like, what's the difference between Exxon at 9% and Verizon at 8% yield? The problem is, it's the company. Verizon's got a lot more debt. The environment that they're in, they're not anticipated to generate any additional, or not as much growth. And they're also, because their debt payments are so high, they're not going to be able to have as much free cash flow to pay their dividends, which makes it a little more risky and scary. Exxon, it was only like a year or 2 years during the pandemic when like the thesis changed where everyone thought oil was going down and going away and blah 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 blah. So the actual company itself and in the sector was just getting hit pretty hard. And that gave an opportunity to buy a stock very cheap. Verizon might seem cheap, but the risk is riskier. I'm not sure if I got my point across between these two, but there's a difference between a stock dropping in price and the yield like being a lot higher, and it being good and it being bad. And deciphering that is challenging. But yeah, that's why the dividend ETFs are always pretty good too, because you don't necessarily have to worry about that because you got whoever's managing it to kind of worry about that. And if any one company does, falter or default or something, it's like I know for wow, I cannot speak. SCHD, they're only allowed to have 4% of any stock in the portfolio at any given time, and only 25% in any sector at one time. Yeah, I think I explained. This is good for me too, because I wanted to kind of put it all on paper. personal strategy, trying to figure out. So so I'm trying to think. Do we want to do some numbers? My portfolio, like, no matter what, the thing with this type of investing, I want to be clear too, is I think people on YouTube see, like, oh, if you had $1 million, oh, and you're yielding 4%, bro, you're making $40K a year. But it's like, yeah, sweet. But we don't, no, I don't think anybody watching this video is gonna have $1 million to do this. So the percentages are low. So let's say you got 10 grand. I think, I'm not sure how old everybody is, but I'm pretty sure people might have 10 grand as an investment. Yielding 4%, that's $400. And it's like, it's not a lot of money, but it stacks over time. And if it's, as long as you're not losing the 400, or sorry, you're losing your initial investment, you know, that does compound as you add more and more money to into those yields, or like bonds or whatever. As you add, let's say you do $10,400, it continually goes up. But the thing that I'm trying to say here is, it seems good on paper. Oh, let me build this passive income portfolio for dividends. I'm gonna make my $10 every month, blah 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 blah. In like 30 years, I'll become a millionaire, and it's like, great. But that's not for me, I guess. But then you're probably like, oh, then why are you doing this? This money that gets put into this category is money that I don't want to lose, but I want it to yield some sort of money for a long period of time, or money I don't want to lose, but at least I can yield some money. I'm not gonna say riskier other things that I'm buying, but I have other things like different stocks. I have collectibles like Pokemon and Yu-Gi-Oh! I got a bunch of different YouTube channels, so that's sort of my way of spreading it out. This is my cushion, my little safety thing, where it's like things that go here. I don't want to lose, but I want it to be consistent, and so I'm kind of like distinguishing between the two. Hopefully my point got across. Hopefully, I don't know if I explained this the best I could, but it definitely helped me understand, kind of laying everything out that I've been looking at for a couple months. Actually, I guess years, not even a couple months. But the times have changed in the sense that stocks are not the only best investment. You got bonds now, even cash. I do not underestimate the power of that. If you can find like 4% on cash, it's crazy, but even better, like 5% on bonds. I think people get so tunnel visioned on dividend stocks, or just certain things in the stock market specifically, and it's like, there are other investments out there. Do not forget about them. Just because a lot of people don't chat about them on YouTube, doesn't mean they don't exist. Again, cash and bonds, I'm not going to say 0% risk. Cash has almost 0% risk when you're in these accounts. I mean, hopefully the bank doesn't default or go out of business or whatever, but very low risk. T-bonds, U.S. government bonds, essentially 0 risk. I'll say like 0.5% risk. Just throw some number out there. You can buy the corporate bonds. I have not really seen good corporate bonds lately. But corporate bonds also, if you go taxes, don't forget taxes, guys. If you buy T-bills, sorry, taxes and fees. If you buy T-bills or corporate bonds through a government, through a brokerage account like TD Ameritrade Fidelity, the brokerage sometimes takes additional fees on that bond. So that just decreases your yield even more, so definitely take that into consideration. And the T-bills, you just buy them off Treasury Direct. That's like the main government website. Save yourself a lot of extra, it's the numbers game. If you can make 0.5% more on one of your investments just by being a little bit wiser about how you go about it, that's a lot of money in the long run. I mean, even if it might not seem like a lot, if you're at like 10K, buying a bond, and I'm only gonna lose like to $50 or $5. It's like, yeah, but like if you did that like 100 times, it adds up. Taxes and fees, don't forget about them. Fees are important. The expense fees on dividend ETFs pretty low, but they're there. Something to take into consideration. One thing too, actually, real quick, is SPG. It's a REIT. Same thing. O Realty. They will never be qualified dividends. That means they will never be taxed at a lower tax bracket. Things like Exxon, Snap-on, Verizon, if you hold them for like over a year, then yeah, they will get put in a lower tax bracket. But Simon Property and O, they will never, because they're a REIT. So when you're deciding to buy companies or stocks specifically, and let's say SPG is yielding 5% and Exxon is yielding 5%, one of the things to take into consideration is, okay, if I hold this for 5 years and they're yielding the same amount, maybe SPG increases the dividend. Yeah, there's other variables to take into consideration. But Exxon, you will eventually get they will be taxed at a lower percentage, and that gives you in return a higher yield in a sense compared to some other company. But again, that's just one of the variables you have to take into consideration. But yeah, I just wanted to point it out. Anyway though, hopefully you enjoyed the video. Hopefully you enjoyed my TED Talk, my disgustingly written handwriting. And just my approach, I think, and how I want to do investing from a more risk-averse point of view, but for the purpose of generating cash flow as opposed to just appreciation. And again, there's appreciation is great when investing in. You can make a lot more money, but I think the risk. I don't care for that risk. I hate losing money because it's hard to earn. Not hard to earn, but you have to earn the money, and I hate just watching it go away by making a bad decision. Hopefully this philosophy though saves me from that. So again, my investing approach. Hopefully you enjoyed the video. Stay tuned for some more financial, I guess, personal finance, investing chats and whispers. Let me know some thoughts down below or in some of the videos you want to hear me discuss. Have a good night, everybody. I'll talk to you all in some other